I'm Rob Tetrault from robtetrault.com, Senior Portfolio Manager at Canaccord Genuity and the Tetrault Wealth Advisor Group. As you probably know, I have a deep passion for private real estate. I've talked about it many times, and I'm thrilled to have this gentleman on our show today. Before I introduce him, talk about what he's done. Founder, CEO of Rise Properties. Rise Properties oversees $2.7 billion of real estate, mostly in the U.S. Northwest and the Seattle, Oregon region. They've generated phenomenal returns for their clients. If you're a client of ours, you've owned this for a while, so you probably know, averaged over 14%, and they're about to hit their 10-year number, 14% return, extremely tax efficient. A lot of that distribution is either deferred cap gain or return of capital, which is basically close to tax-free in the year you receive it. They've generated those returns. Last year, they generated north of 20% returns. And again, this is done through real estate. They have a model where they buy undervalued real estate. They reno some of the suites. They try to increase the revenue a little bit. And then because the NOI goes up, the actual valuation of the property goes up. They've been doing this for a long time. I'm thrilled to have him on the show today, none other than the chairman and the founder of Rise Properties, Dave Kersinger. Dave, thanks for being here.
Thanks, Rob.
If you'd love to chat about this or anything else in your portfolio or in your investments, go to www.speaktorob.com. Don't forget to like, subscribe, follow, give us your comments. We'd love to hear from you on that as well. All right, Dave, let's get right into it right now. We got about 5 minutes off the top of the show to talk about private REITs versus public REITs. What do you say to the individual who tells you private REITs are a bit of a waste of time because there's already a market that exists for publicly traded real estate, which gives you a fair valuation? It's whatever the market thinks it's worth today. Why wouldn't we just invest in publicly traded REITs?
Thanks, Rob. So I've had experience with both. I was a vice president with Avalon Bay Communities in the United States, the largest public apartment REIT. And of course, we have Rise as a private REIT. Really all comes down to volatility. If you track public REIT pricing, it's very volatile because the pricing is at the whim of the market. It's not necessarily dealing with the underlying real estate. Whereas with private REITs like ours, the pricing of the units is strictly driven by the value of the real estate at that time. So much less volatility.
Wouldn't you argue, though, that like the real valuation would be whatever the market thinks it's worth? Who cares what a third-party appraiser says it's worth?
Short answer is no. In this regard, I remember being at Avalon Bay, being in an executive meeting, and everybody said, "What's happened to our stock price?" And everybody around the table said, "Well, I hear it was the .com boom. Everybody's into high tech. We should change our name to AvalonREIT.net, and then our price will go up." So the public markets can be very efficient. They're very good. They obviously serve a purpose, but the volatility can lead to some mispricing of public real estate, and it can come at a bad time. When the pandemic hit, public REITs went down in value a lot, even though their real estate was not going down in value. The market was just worried and concerned, whereas our pricing stayed much more stable. So there's good news and bad news about both, but we like the what we consider to be the good pricing model of private real estate.
Tell me about your pricing model. How does a shareholder who owns Rise Properties, how does he or she know that the valuation that they're seeing on their statements is a true representation of what the shares are actually worth and what the real estate is actually worth?
Yep. When we started Rise 10 years ago, I knew that I was going to be, soliciting friends, family, things like that to get going. And we thought, what's the best way to do this? What's the correct way? And we came up with well, it's not really our idea, but we studied some other private REITs that we thought were really doing the right thing by their investors. Bottom line, it comes down to third-party appraisals. So we have every property fully appraised at the end of every year, and we get quarterly updates. And it is those appraised values that start then the math or the work through to the net value, because we have to subtract out any potential taxes or brokerage commissions that might exist if we were to sell the portfolio. That gets down to a net value. You divide that by the number of units. That gets you your unit value. So very arm's length valuation process. And I want to say we only use national appraisers, and we change our appraisal firm every 3 years to maintain that arm's length relationship.
You can't get them in your back pocket, right? That's the idea.
No, they. I was going to joke that we try, but that wouldn't sound good. But
okay,
no,
so
yeah.
No, you're
Go
using
ahead.
a third-party appraiser. You're changing every 3 years. They're evaluating basically it's a multiple of the NOI. I would imagine NOI standing for net operating income, and they use a cap rate. And I imagine they look at other cap rates. They factor the NOI times the cap rate, and they figure out what the real estate's worth, roughly.
They actually, on the full appraisal, there's three metrics that they use. One is replacement cost. One is price per unit and price per square foot relative to market sales. And the third one is a projection of net operating income actually divided by a cap rate relative to the quality of the property. I will say that the one that probably they lean to the most is the cap rate and the NOI and that mathematical analysis, but there certainly is a review of market sales comparables as well as what's going on with replacement cost.
So you guys you as chairman or the guy at the top, do you have any say in kind of a range of what value you put on your shares? And then my follow-up question to that is, how about loan loss provisions? We just went through a pandemic. How do you factor in for that? And have you ever factored in for a potential loan loss on parts of your portfolio?
So we have a fiduciary responsibility that we take very seriously to that we have to agree with our appraisals in general. We have to believe they're in the realm of reasonableness. And we've always been able to do that. So we have never adjusted our valuation based on our judgment of the market versus the appraiser. In terms of loan losses, we have mortgages on our properties. And if we were to sell everything right away, there would be some prepayment penalties. But we don't look at that in terms of the valuation because we have no intention of selling the whole portfolio at one time. We're typically about 25%, 20 to 25% variable, which does not have onerous prepay penalties. And the balance of the mortgage portfolio is in the 10-year debt maturity ladder that roughly has about 10% of our debt maturing every year. So we don't anticipate or see a reasonable circumstance where we'd have a lot of loan loss or prepayment penalties or those kinds of things.
What I meant kind of on the loan loss was more like you get a recession and all of a sudden your buildings are half empty or something, and like kind of a worst case scenario where you actually have to write down the value of your real estate.
Well, the great thing about apartments is that unlike retail or industrial or office, you're never going to see a building 50% occupied. The worst I've ever seen is we're running maybe high 80s, 90s, and that was 20 years ago during the Great Recession. And then we also have a very conservative debt profile on our portfolio. We're less than 50% levered, and we have better than a 2-time multiple of NOI on debt service. So we're very, very well covered for any kind of major disruption like that.
Okay. Let's move over to you personally. On the boardroom here, we like to talk about the CEO. We're blessed and honored to have CEOs come on the show and talk to us about themselves. So first off, we're going to take some quick shots. Tell me what got you into the real estate industry. How'd you start? And how old were you?
How old was I? I was a little older in that I was probably 32 when I got into it seriously. My parents bought and sold a few homes and fixed them up in good old Victoria, British Columbia, where I grew up. I was born in Saskatoon, like I said, so I've got my prairie roots. But and then when I went back to Stanford and did a master's in business administration, I really thought through what do I want to do for the rest of my career. And I like the entrepreneurial nature of real estate. I liked multifamily rental because I wanted to live in the Pacific Northwest and knew there'd be a lot more people and they'd need housing. So that drove me, and I've been doing it for 33 years.
Okay, and what are some of the lessons you would give to another kind of aspiring CEO or leader that you learned over your time? Kind of quick tips for leadership.
For leadership, that's great. Well, I was fortunate at Stanford. Jim Collins was one of the professors there who wrote Good to Great and Built to Last and stuff like that. But a book that he's written that I have read many times and actually taken notes on is called Beyond Entrepreneurship. How to turn your business into an enduring great company. And in there, they talk a lot about core values, vision, mission, people, and the role of a CEO is really about those very high level things. So that book was very, very influential to me. And it's part of what we do at Rise relative to our core values and our purpose as a company.
We'll talk about change later, but specifically when you're implementing change, are you a guy who likes to see kind of shallow, uh, one-off changes, or are you more of a transformational change kind of guy when you kind of took over, and then when you're implementing change at the CEO level?
I'm more of a transformational guy. I'm more of a meat and potatoes guy. I'll leave the high tech wizardry and some of those major transformations to some other endeavors. In terms of what we do, it's really kind of simple in that we own these apartment communities. We have residents. We take good care of them. We have our associates who are employed by us. We empower them to make good decisions, create a sense of community, and those kinds of changes are, I would call, more transformational than radical. Although, a couple of the renovations that we've done have been very transformational from a physical perspective, where we've taken an asset that was really tired, not being well run, and we've spent a lot of money on them and really turned them around and repositioned them within the marketplace. So I guess from a physical standpoint, we've been somewhat transformational at times, but from a pure business model, we've been more transformational.
I was on one of your properties, visited them, I don't know how many years ago, and I
Yeah,
remember thinking, like, you could never get away with this in Canada. You could never get
right.
away with kicking a tenant out for one weekend and saying, "We're going to redo the cabinets, the flooring, we're going to redo the marble countertops and whatever else you guys are doing, and do it all in one weekend, and then immediately have the opportunity to charge a bigger rent, or immediately, I should say, on the next lease up, I would imagine you have the opportunity to charge more rent, and an accretive valuation to it's an accretive move to the company. You guys are doing that successfully.
Yes, and the landlord tenant laws in the United States in general, and certainly in Seattle and Portland where we operate, are more landlord friendly. But we actually renovate some of our apartments while the resident is still living there. So we don't ask them to leave. We actually make everything neat and tidy by 4 or 5 o'clock in the afternoon. They come back, they enjoy their home. It takes us about 3 days of solid work, very coordinated, and we do what we call in unit or occupied renovations. Now, sometimes we have to do more dramatic renovations, and then we do it when the resident's lease has expired. We say, I'm sorry, we need your apartment. We take control of the apartment. We offer them a new apartment in the community, or at times they choose to go to a different community. But you're absolutely right that we have the ability to take these homes, renovate them. We also have the ability to raise rents at the end of the lease term, as opposed to having rent control.
I remember another story here in the quick shots 1 minute. Do you have a dog, and what revenue model have you been able to see to increase the revenue relative to dogs?
To dogs, yes. Okay, when you said, do you have a dog, I thought, wow, I had a dog back in Calgary. But
No,
so
it's a legit question. Do you have a
I
dog?
don't,
And then
I
you're going
don't,
to say,
no, no,
I
it's
don't.
great. Yeah,
But then
it's
the
great.
follow-up was going to be, if you did have a dog, clearly you're willing to pay the $50 a month or the $25 a month to
Right.
get access to the dog park.
Absolutely. So we have seen a lot of young people, and I have two daughters who are in their 30s, and they both have, in fact, between the two of them, they have 3 dogs. So we saw, and we weren't the only ones, but we saw a lot of demand for people who wanted to have dogs while they were residents at our community and renting. So we and others have put dog parks onto our properties, doggy toys, doggy biscuits, the bags. And when people see this facility, and we actually do professional dog wash stations on the property so they can go clean their dog. And we can charge pet rent. So we charge roughly $50 per month per dog for every resident who has a dog. If they see good facilities, they want to come and rent at our community. It's almost like their child. And that $50 a month is $600 a year of added revenue. And when we're buying 5 cap properties, the valuation is a 20 multiple on revenue. So
It's a
that
big number.
Fido adds $12,000 worth of value to that home when that strategy is properly executed on.
We got a COVID dog. We got a dog, a little curly, a little Labradoodle last year, and I guarantee you we'd pay the $50 a month. That's for sure.
Yeah,
Let's talk about ESG. How would you apply ESG? So that's environmental, social, and governance factors to your REIT, or do you?
we do. And this has been a big issue for companies, and I applaud companies that are embracing it, and we are certainly embracing it. We hired a consulting group to come and help us better understand ourselves and what really motivates us. And I won't bore people with the details, but we have said that our purpose is to improve the lives of people that is to improve people's lives. And so we want to improve our investors' lives by giving them good returns, our residents' lives by great communities, our associates' lives by a good job. And tied in with that, we know that people are concerned about the environment. They are concerned about social and governance. So on the environment side, we've made an effort to qualify for green loans. So reducing water consumption through aerators, through low-flow toilets, through sub-metering apartments so that residents know what their consumption is and pay directly for their consumption. More recycling. On the social side, we're empowering our communities and providing a budget for them to do social work, not social work, but to get involved with local charities and things like that. And then on the governance side, we've continued with our commitment to a strong board, very disciplined quarterly board meetings and those things. So we're active in it, we're growing in it, and we want it to be a difference in our organization.
Let's talk growth. Where do you see the growth coming in the multifamily real estate sector? I mean, the pessimist would say there's no population growth. You're not, there's not more people moving. Like, your only real growth is immigration. What would you say to that?
I would say that at a macro level in North America, more so in the United States, population growth is stagnant. But at the more urban or city level, it certainly is not stagnant. And one of the reasons that we like Seattle and Portland, and we went back and studied it for over the last 35 years, Seattle and Portland have averaged 60% better job growth over the last 30 to 35 years than the US on average. Well, and people come to cities to take jobs. So It's not surprising that the population growth of those two cities has been approximately 60% greater than the US average. And then the icing on the cake is both cities have barriers to growth. So Seattle has geographic barriers with Lake Washington, with the Pacific Ocean, et cetera. And whereas Portland has an urban growth boundary where they kind of drew a ring around the city and committed 20, 30 years ago that they wanted to densify the city and not have sprawling infrastructure. So when you get that combination of better job growth, you get better population growth, and then you get and barriers to growth, you get much better appreciation of any kind of housing.
Okay, let's talk a little bit here. Let's take a few minutes here and chat about overall real estate, and I mean other sectors of real estate. So you guys obviously have decided to get into the private multi-family real estate. So people pay rent. Is it mostly townhouses? I've seen your buildings, but feel free to describe them. But basically, it's multi-family over multiple buildings, either townhouses or apartment blocks, that kind of style, right?
Yep, we're predominantly what Canadians were referred to as a condominium. So we're multifamily, where we have some properties that are townhomes, but the majority of our properties are flats or a unit over a unit. They might be 2-3 stories. We actually own some high rises as well. And along with our joint venture partners, we now own a little over 6,000 apartments between the two markets. But yes, our focus, and we think part of our competitive advantage has been a strict focus, strictly multifamily rental in our select markets, which today are Seattle and Portland.
Stick to what you're good at, stick to what you know, right? And do it very, very, very well and better than anyone else.
Yeah, and something that came up today was, with the pandemic, staffing is difficult for everyone, grocery stores, et cetera. A big part of our strategy is to get a scale in select markets rather than have exposure to a whole bunch of markets. So with the pandemic, we're experiencing about 5 or 10% of our staff on site are either ill with COVID or are being quarantined because of it. But because we have all sorts of properties around each other, and we manage now about 17,000 apartments just between the two markets, we can create a pod system with our staffing to make sure that no one property loses half their staff or 3/4 of their staff for an extended period of time. So there's some sharing that comes with that focus and critical mass in a market, as well as market information, because if we're operating several thousand apartments in a chosen market, we have market information that other people don't have. We know what went on this morning at the rental communities.
Now let's talk about the other real estate sectors. Do you see any growth? And let's talk specifically office, retail, healthcare, and maybe we could start with those. What do you think? What do you think is the future for those?
Yeah,
maybe we could start with office and retail. Office and retail are getting bloodied right now, right?
Yes, and I think another big principle for us with Rise was to be an open-ended fund, because we look at everything long-term. I'm a big believer in demographics. I'm a big believer in reading the newspaper and try and figure out where things are going. And there are black swans like the pandemic that none of us could have considered. And certainly the work from home thing, I don't think anybody 3 years ago would have thought would have been as prevalent as what it is now. But so as it relates specifically to retail, I think, there's, for well-located, good quality retail, it's there, but by and large, the wind's in your face in terms of the amount of online shopping that's happening. With office, we've got the work from home thing, and I think that's an uphill battle. And some of these tall office buildings are being turned to apartments, rental, because people always need a home over their head. Obviously, warehouse is doing really well because of the online business, and then you did mention medical, and I'm a big believer that as the baby boomers are aging here, the demand for medical attention will go up. So I think that's a good asset class.
Yeah, it's the industrial side is changing as well, right? Like the warehouses and storage REITs and all these. It's an area that we weren't really talking about 5-10 years ago, right?
For sure. And article this morning that Portland's industrial market is its lowest vacancy in the last 20 years, which shows nice demand from employers and companies wanting to be there. I'm very biased to apartments, and one of the things that it unfortunately adds value to apartments is NIMBYism. People don't want a lot of housing or multifamily housing built around them, and I think that as an investor helps us realize above average gains. On the industrial side, well, I think there's great demand, and it's a really good asset class, big picture. I don't think you're going to get, if you have land zone for industrial, I don't think you're going to get as much opposition to building more industrial like you might with rental housing in a more urban, suburban context.
So less value then, right?
Yeah, less value.
If there's no there's no one stopping from building a million buildings, you get lower barriers to entry and less value, right?
Yeah, I mean it's simple supply and demand. Demand for industrial is there, demand for rental is there. Then you got to look at which markets might curtail supply, and we're a believer in markets that have barriers to growth as opposed to markets that can just expand. I often joke, because like I said, I was born in Saskatoon, but I grew up in Victoria, but lived a lot in Vancouver. I said 25. If you had $1 million 25 years ago and you had to invest it either in Saskatoon real estate or Vancouver real estate, I think you would have done a lot better in Vancouver than Saskatoon. Saskatoon's a wonderful city, lots of relatives there, but there's really it's got some good job growth with the oil and gas industry and stuff like that, but it's got no barriers to growth.
Sounds like you're pissing on Saskatoon a little bit.
I know, the Rough Riders. My cousins are not. I have a lot of cousins in Saskatchewan.
the neighboring province over. All right, I want to spend a couple minutes to talk about risks. Risks investing in multifamily real estate specifically. The big one that everyone's talking about, interest rate risk. I want you to dissect it for me and how your fund would be impacted with a 50 basis points, 100 basis points, 150 basis points hike. And I'm not asking for the numbers, but just what it would look like for you guys.
Yeah, no, it's a great question as well. There is some thinking that if interest rates go up, cap rates will go up. If cap rates go up, values will go down. Historically, if you look at that, it's interest rates definitely play a role, but supply of money probably plays more of a role. And right now, we're seeing interest rates that are 200 to 300 basis points below the rate of inflation. So there's a lot of money that wants these apartment buildings, which is increasing values. So I think that it's to look at interest rates going up means cap rates will go up is a bit simplistic relative to the amount of capital that want these assets and the spread between interest rates and cap rates.
But that would be more just on a valuation metric, right? So you're saying just on a pure valuation metric, interest rates might not move the cap rates as much as you think, Rob. What about on the impact that the interest rates are having on your NOI?
Yeah, and we manage to certain disciplines, and one of them is fixed rate debt versus variable rate debt, and trying to match our debt maturities to a 10-year debt maturity ladder while maintaining conservative leverage. So specifically, we are less than 50% leverage, less than 50% debt on our assets today. We have a better than 2 times cover ratio on our mortgage payments. We 70 to about 80% of our debt, or 75 to 80% of our debt today is fixed, so rates going up doesn't impact it. And on the variable rate debt, the spreads have come down, but bottom line, we're not very exposed there. And then if your debt is maturing 10% a year, you've built in some safeguards or guardrails where even if rates move quite dramatically, there won't be any kind of short or medium term meaningful impact on our ability to pay our mortgages.
Okay, and I mean it won't be impactful short term, but it definitely will be at some point when this debt matures, right? So it's kind of like you're going to pay the piper at some point. But I think what you're saying is, if interest rates go up 100 basis points in the next 18 months, well, we still have 80% of our debt that won't be mature yet and won't be maturing. So we're fine.
And the other side of that coin is that if you look historically at apartments, they've typically done well in an inflationary environment. So if interest rates are going up, chances are that you've got inflation. And if you've got inflation, chances are rents are going up. So, like everyone, we have close to 500 associates now between Seattle and Portland, and we're seeing a lot of pressure on entry-level wages, et cetera. And I've said to some of my business partners, this is actually a really good thing. Number one, I think it's good because I think that these people, it's nice to see them get more money. But the other thing is, from a selfish perspective, they can afford more in rent. So if we see interest rates move up a meaningful amount for a meaningful period of time, I think it's safe to assume we'll have inflation. If we have inflation, we'll see rents go up, and we'll be fine.
And the neat thing for you is that your cost, your revenue is not tied to a 10-year ladder. You can increase revenues. You can pass on the inflationary costs onto your renters in a fairly short order, whether it's 6 months or 12 months or 18 months. You can pass on that inflationary cost to the renters fairly quickly, and you don't have to pay the piper for 10 years on the interest rate. So you're getting the benefit of the inflation up front, and you're getting the cost of the increase in interest rates spread out over 10 years.
Correct. We rarely do anything more than a 12-month lease. So we have an ability to adjust pricing on every apartment that we own in a 12-month period. So it's very, very different than a retail lease or an office lease or a medical building or industrial.
All right, let's do some rapid fire questions here to wrap up this episode. So what are your thoughts on crypto, real quick?
I made a crypto investment believing that it would help me want to learn more about it. I didn't learn any more about it, and I lost some money. And it taught me that only invest in things that either A, I understand, or my financial advisor understands.
You sound like Warren Buffett. 2, what's your favorite movie?
Oh, my favorite movie is Freddy versus Jason. I have a brother who's now 60, very athletic guy who spent his whole life as a Hollywood stuntman, and he was Jason in Freddy versus Jason. So I love the movie, and I actually got to go to the Hollywood premiere when it premiered probably about 20 years ago.
Nice. What's the Canadian city with the most potential for growth?
Oh, that's a good one. That's great. I would like to think that the prairie cities in general have a lot of potential, because I think that maybe some of them got focused on oil and gas, or some of their local industries, be it agriculture, etc. And I think maybe some of these shocks are teaching them that they've got a very good, well-educated population, and if they expand their thinking, that they can do quite well. So, I spent 9 years living in Calgary, and I love Calgary, great city, and I just like to see those young people grab onto some new high tech, etc., and just show what they're up to.
Biggest fish you ever caught?
Well, the biggest fish I ever caught was 33 pounds of Chinook salmon. Very proud to say our son-in-law got a 68-pound salmon 2 summers ago at a place called Rivers Inlet on the West Coast, and I might go up there with him this year and see what I can do.
Last question for you, the 2022 Stanley Cup champion.
I want to say Vancouver, but I'll
not the Kraken. I'll tell you, it's not the Kraken.
No, not the Kraken. I'll go with a repeat. I think the Lightning have a good shot. But I know you all are partial to your Jets, just like we like our Canucks.
Yeah, but we got problems in Winnipeg for depth, I think, on the forward side, depth on the defensive side, and consistency in goaltending. I never thought I'd say that with Hellebuck. But regardless, thank you so much for your time today, Dave.
Yeah.
Really appreciate you, value you being here. Thanks so much for tuning in. Guys, if you'd like to book a no obligation consultation to chat with me about how something like this could fit in your portfolio, go to www.speaktorob.com. We'd love to book that for you. Don't forget to like and subscribe, press that red button, click it, and give us your comments. We'd love to hear from you. Thanks so much for tuning in. We'll see you in the next episode.